Welcome to the Deep Dive, where we slice through the noise to bring you the essential insights from influential ideas, our mission today, to really get into a titan of finance. Burton Malkiel's A Random Walk Down Wall Street.
Mhm. I mean, this book, it's shaped how generations think about investing. We're going to unpack why it's still so powerful for you today. We'll look at his famous random walk theory, the idea that stock prices are, well, surprisingly unpredictable, and how that simple concept kind of challenges, traditional Wall Street thinking. You'll discover his straightforward, data-backed advice. Ready to jump in?
Absolutely. It's really a foundational text, and it's not just about stocks, is it? It digs deep into market psychology, the crazy history of investing fads, and honestly, some of the best advice out there for regular investors.
Okay, so let's start with that core idea, the random walk theory. What's Malkiel actually saying there? That prices just bounce around with no rhyme or reason? Well, not exactly chaotic, but unpredictable in the short term. He argues that prices react so quickly to new information that any pattern you think you see is probably just randomness. Past movements don't really predict future ones in a way you can consistently profit from.
That must have been pretty controversial, especially back then, challenging the pros who claim they can predict things.
Oh, absolutely. It was a huge challenge because it suggests that trying to constantly beat the market, pick the right stocks, time your entries and exits, it's almost impossible to do consistently well over time. He's basically saying the market is pretty efficient at pricing things in almost instantly.
Okay, so if actively picking stocks is like a fool's errand, according to Malkiel, what does he suggest instead? What's the alternative path?
Right. He doesn't just leave you hanging. His advice is deceptively simple but powerful. He champions long-term investing, thinking in decades, not days, and diversification. Don't put all your eggs in one basket. Plus, using low-cost index funds is key. Just buy the whole market, essentially. And crucially, harness the power of compound interest. Let your money work for you over time.
Simple advice, but you mentioned it's data-backed, not just opinion.
Exactly. That's the beauty of it. It's not just theory. He presents decades of market data showing these strategies tend to outperform the more complex, active approaches, especially after you account for fees and taxes.
Interesting. And you mentioned psychology earlier. Malkiel really hits on how we as investors can be our own worst enemies, right?
Oh, definitely. That's a huge part of the book.
Yeah.
He gets into behavioral finance, how our emotions like fear when the market drops, or greed when things are soaring, or even just being overconfident in our own abilities. How these feelings constantly lead us to make poor decisions. Buying high, selling low, the classic mistakes.
Yeah, you see that all the time. People panic.
Exactly. He shows how understanding these biases is almost as important as understanding market mechanics. It's about mastering yourself. And this links right back to the efficient market hypothesis, the EMH.
Right, the EMH. So if the market's efficient, all known info is already baked into the price.
Then, trying to find some secret edge, some undiscovered gem, is mostly down to luck, not skill. The market digests news incredibly fast. By the time you hear about it, chances are the price already reflects it.
Okay, that makes sense. And it leads straight to his big point about index funds versus actively managed ones.
Yes, he's a huge advocate for low-cost index funds.
But wait, surely some professional managers do beat the market, right? You hear about star fund managers all the time. How does Malkiel explain that?
He acknowledges that some do, for a while. But the data shows it's incredibly hard to do it consistently year after year, especially after you subtract their higher fees. It's like flipping a coin. Some people will get lucky streaks, but over the long run, the average outcome is, well, average. And those fees from active managers really add up, creating a major drag on your returns compared to a cheap index fund.
So the odds are just stacked against consistent outperformance with active funds for most people.
Pretty much. For the average investor, indexing is a much more reliable path, according to Malkiel and the evidence he presents.
And he uses history to drive these points home, doesn't he?
Yeah.
Talking about market bubbles and crashes.
Yeah, that's one of the most engaging parts. He covers things like the Dutch tulip mania back in the 1600s, absolute insanity over tulip bulbs, and then more recently, the dot-com bubble bursting around the year 2000.
Right, I remember that one vividly.
These stories are powerful reminders of what he calls irrational exuberance, how crowds can get caught up, push prices way beyond any reasonable value, and then crash. It shows how detached from reality markets can sometimes become, driven by that same human psychology we talked about.
So it's theory, psychology, history.
Mm-hmm.
But he also gives practical advice for different life stages, right? It's not one size fits all.
Not at all. He tailors the approach. If you're young, say in your 20s or 30s, you have a long time horizon. So he'd suggest you can afford to take more risk, have a higher allocation to stocks, potentially for higher growth. But if you're nearing retirement, the focus shifts. Preservation of capital becomes more important. So you'd likely shift towards more bonds, less volatile assets. It's about matching your portfolio to your timeline and your ability to handle risk.
Makes sense. And what about that strategy, dollar cost averaging? It sounds simple, maybe too simple.
It is simple, but that's its strength. Dollar cost averaging just means investing a set amount of money at regular intervals, say every month. You invest the same dollar amount regardless of whether the market is up or down.
So you're not trying to guess the perfect time to buy?
Exactly. You take timing out of the equation. When prices are low, your fixed amount buys more shares. When prices are high, it buys fewer shares. Over time, this tends to lower your average cost per share. And maybe more importantly, it enforces discipline.
Yeah.
It helps you avoid making emotional decisions based on market noise.
Just keep investing steadily.
Steadily. It smooths out the bumps and keeps you invested for the long haul, which is key to Malkiel's whole philosophy.
Okay, so let's be really clear here. Who is this book and this deep dive really for? It's not a get-rich-quick guide, is it?
Definitely not. If you're looking for hot stock tips or secrets to overnight riches, this isn't it.
Yeah.
You'll be disappointed. But if you want a sensible, research-driven approach to building wealth over the long term, if you want to understand how markets actually tend to work beyond the hype, and if you want practical, timeless advice that cuts through the noise, then yes, Malkiel's insights are absolutely essential.
So whether you're just starting out, maybe feeling a bit intimidated by investing, or even if you've been in the market for a while but want a more grounded strategy.
Yeah, there's immense value here. It really helps demystify Wall Street and gives you a solid framework.
Looking at the big picture then, a random walk down Wall Street feels like more than just investment advice. It's almost a philosophy.
I think so. It's a mindset reset. It's about rationality, discipline, and patience in a field that often feels chaotic and driven by emotion.
A reminder that slow and steady often wins the race, right?
Mm.
Discipline over prediction.
Precisely. And think about today's world, constant news cycles, social media hype, crypto frenzy, meme stocks. It's noisier than ever.
Yeah, it's intense.
So here's something to consider. In this modern era, how could embracing Malkiel's core ideas, that long-term view, the diversification, the low-cost indexing, the discipline, how could that provide a more resilient, maybe even less stressful path for your financial future? What would applying that discipline simplicity look like for you?